The corpse is already cold. We are standing over the body of the world's largest asset class, Chinese real estate, and the authorities are telling us it's just sleeping. On January 29, 2024, a Hong Kong court ordered the liquidation of China Evergrande. The media called it the end of the saga. They lied. It wasn't the end. It was the first piece of a much uglier puzzle. We are looking at a hidden default mechanism so complex, so vast, that it distorts the very concept of bankruptcy. You think this is a Lehman moment? No. Lehman was a heart attack. Sudden, violent. This is radiation poisoning. Today, we aren't just reading the news. We are reconstructing a crime scene. I have the bank capital ratios. I have the bond rejections. I have the secret IMF stress tests. They thought they were different. They thought they could defy gravity. Here is how the domino falls. Let's put the first piece on the table. It looks like a rescue, but it's actually a trap. May 2024. Beijing drops what looks like a nuclear payload of stimulus. They slash down payments for first-time buyers to 15%. That is the lowest level since the 2008 financial crisis. They remove the floor on mortgage rates. Bruce Pang from Jones Lang LaSalle called this a hope for a decisive victory in a technical knockout. But look closer. Why do you lower standards to historic lows? You don't do it when business is booming. You do it when you are desperate to find a bag holder. The narrative is that the government is stepping in. But Raymond Cheng, the head of China research at CGS International, gave us the real clue. He admitted that while this might stabilize sentiment, elevated housing inventories will likely keep real estate investments suppressed for some time. Suppressed is polite code for dead. The irony here is brutal. By slashing rates and lowering the bar, they aren't fixing the problem. They are admitting the assets are toxic. They are trying to lure the average citizen into a burning building to save the furniture. Reuters data confirms home prices are set to decline 3.7% this year. They keep falling next year. Stability doesn't even enter the conversation until 2027. This isn't a recovery. It's a liquidation sale disguised as policy. Piece number 2. This is where the smell of rot gets undeniable. Forget Evergrande for a second. Look at Vanke. China Vanke was the safe one. The state-backed giant. The responsible adult in the room, and yet Vanke bondholders just rejected a payment extension. Vanke onshore notes are trading at distressed levels, 20 to 30 yuan per 100 face values. Offshore dollar bonds hovering near 20 cents on the dollar. When a bond trades at 20 cents, the market is screaming that you are already dead. A senior executive from a defaulted Shanghai developer spilled the truth. He said these new policies are just psychologically letting investors think the government is paying the bill. Pay attention to that phrasing. Think the government is paying. They aren't paying. They are shifting. The executive explicitly stated this is about shifting the risks from property to banks and local governments. This is the hidden default mechanism. You don't declare bankruptcy. You don't close the doors. You just turn the company into a zombie that eats the capital of the state banks. The origins of this mess are a textbook case of moral hazard. Lenders lent billions because they assumed Beijing had an implicit guarantee. They thought they were different. They believed the party wouldn't let the music stop. But Vanke's rejection proves the guarantee is a myth. The bondholders know it. The market knows it. The only people who don't know it are the ones reading the official press releases. Now we connect the third piece. This is the one that terrifies the IMF. We know the developers are broke. We know the government is shifting that debt to the banks. So what happens to the banks? The IMF ran a simulation, an adverse scenario. They modeled growth averaging 1% instead of 5%. The result? Chinese banks' capital ratios plummet from 11% to 7.1% by 2025. 7.1%. That is the danger zone. That is bank-run territory. That is the worst of any region under stress tests globally. As loan losses mount, banks stop lending. When banks stop lending, local governments, who rely on selling land to pay their debts, go broke. They slash investment. They slash social services. It is a death spiral. And here is the contrarian kicker. Conventional wisdom says China is safe because the debt is domestic. We owe it to ourselves, they say. Greg Ip from the Wall Street Journal nailed this fallacy. He pointed out that financial crises in Spain in the 70s and the U.S. savings and loan crisis in the 80s were domestic. They didn't need foreign investors to flee. They just needed locals to lose faith. China's fiscal imbalances have taken the world into uncharted territory. We are watching the second largest economy on earth attempt to digest a poison pill that killed the Japanese economy in the 1990s. But the pill is bigger, and the patient is older. The final piece of the puzzle, the one nobody is talking about because it defies the headlines. Why isn't the U.S. market crashing? If China is the engine of global growth, and the engine has seized. Why are we seeing US CPI at 326.03? Why is the S&P 500 near highs? Because we have already decoupled. Look at the US money supply, M2. It has stabilized at roughly $22.4 trillion. The Federal Reserve isn't printing panic money. They are flooding the zone with liquidity to save Asia. The projected interest rate, cut to 3.64% by January 2026, tells the real story. That is a controlled glide, not an emergency slash to zero. The market has priced in China's death. Here is the irony. The consensus view is that China's collapse is deflationary, that cheap goods will flood the world. Wrong. The hidden default keeps zombie companies alive. These zombies are inefficient. They consume resources they should NT. They keep supply constrained. Evergrande isn't a deflationary event. It is a stagnation event. It sucks the oxygen out of the global room, keeping prices higher than they should be because the efficiency of the world's factory is broken. U.S. data proves the containment strategy is working. The contagion is being fenced off. China is dennant exploding. It's rotting from the inside out, while the rest of the world builds a wall. So here is the completed puzzle. China isn't heading for a financial crisis. It is a financial crisis. The 15% down payments, the Vanke bond rejection, the 7.1% bank capital ratios, these are end-to-end warnings. They are symptoms of a terminal diagnosis. The hidden default is a choice to choose 20 years of stagnation over 2 years of pain. They thought they were different. They thought a command economy could command mathematics. They were wrong. The domino has already fallen. We are just waiting for the sound to reach us. Class dismissed.